Hello, this is Asoka Selvaraj of OnlineTradingRebel.com with an analysis of the Dow Jones Index for you on January the 24th, 2008. Now last week in a previous video I discussed how the market was pinned between very strong support versus the fact that a bearish head and shoulders pattern had completed, implying a strong downside target in the mid 11,000 region, and in fact it was the latter that prevailed. But the complexion has changed very strongly in this market, and this video is going to show you some of the salient features. Now the first thing you see is that the top in October of 2007 on the market came in at a 100% price projection from this low here of 7,181. In other words, if you double that number, you come out with this line, which is 14,362, which is a price target according to the GAN methodology of looking at things. And as you can see, the market came within a microscopic distance of that line. So the target was pretty well achieved, especially when you consider that this is October 2002 and this is October 2007, so it's an exact 5-year cycle to the month between this low and this high, with a price relationship between them as well. So that's the first of many features we're going to discuss. You should also bear in mind, and I'll just mention it now, that the high came in not only at the 5-year cycle to the 2002 low, but at the 20th anniversary to the 1987 crash, and that is also to the month because it was October 1987. So we have two major cycles impacting exactly the same point in time on this chart. Now this is a monthly chart that you're looking at, so each bar is a month, and if we look at it from purely a candle terminology here at the top, we can see the strong white bar with a small white bar followed by a strong down bar, and that in the world of candles is called an evening star pattern, which is a strongly bearish pattern at tops, especially when we realize that this is a monthly chart, so it has monthly significance. And it's immediately backed up by these three down bars in a row, which in candle world is called three black crows. And when that happens at a top, it tends to imply a downtrend has commenced. So you've got two candle patterns reinforcing each other on a monthly chart, which is a very negative incident indeed. So if you were wondering why that trend line looked so strange on the previous bar chart, it's because it's actually a trend line through the closes. So now what you're looking at is the monthly closing chart, and as you can see, we have now taken out the trend line through the closes in just the month of January alone. It's not even finished yet, but it's unlikely to get back above that in just the next week or so. So again, that's the first time since 2002, and that is a strongly bearish sign. The next thing, which I think is very interesting, is what you're looking at now is I have boxed the years. So each green box is a year, and what you'll notice immediately is that in, again, just the first 3 weeks of January, we have taken out the low of the previous year, in fact in the last few days. And not just that, these are now quarterly bars you see in blue, and as you can see, this quarterly bar, which is basically the January bar, has taken out not only the previous year, but it's actually taken out the low of the last quarter of 2006, and that's in just a 3-week period, and that's, to me, is a very negative sign. But the story goes even further than that, because if we look back to the last time in recent history that the low of a previous year has been taken out, you will see that it happened in the year of 2001, around this point actually, in the latter part of the year, I should say just after the middle of the year. And then it led to the market declining very strongly for the following year and a half. And again, people get thrown off because, as you notice, it then rallied quite strongly, and people would have been saying, well, the bull market is back and so on, and yet in fact it was set for dreadful decline. And this is what we could be seeing unfolding here. Now, to back this up, if you go back over the recent history of the Dow Jones, you will see, this is 1982 down here at the bottom, you will see that there basically has never been a year which took out the previous year's low, apart from 2001, and we saw what happened there. It was basically a 2-year correction to the uptrend. So I'm going to go out on the line here and say that I think that we're going to look at least a 2 and possibly even a 5-year correction on the Dow Jones stock market. And that's not to say that it's going to be necessarily a bear market all the way, because if you look at previous decades like the 60s and 70s, what you'll see is that it was all over the place. Previous lows were being taken out, but the market wasn't going anywhere. It just went sideways for 10 years. So it could be that you'll get a wide-ranging, choppy market that basically goes nowhere for years, with shorter-term trends taking place. But there's still more to this story. So now what we're looking at is the Dow Jones again over the very long term, right back to the early 80s, and it's a closing chart once more, and you'll see there are vertical blue dotted lines there. And what this is essentially time cycles projected from the 1987 crash, which we see here in October of that year. And each of these is 60 months, which in Gann cycles we look at cycles of 360, which if you like is degrees of the circle. And 60 months corresponds to 5 years, and 120 months obviously is 10 years. And what I want to show you is a couple of things. First of all, as I think you will have already noted, and as I mentioned, the 240 month line comes in exactly on the high of October 2007. But in case you thought that was a fluke, let me show you what happened each and every cycle as it hit. So let's look at the 5-year cycle, the 60-month line, and we see that the market had traded down for 1, 2, 3, 4, 5 months. It traded down. It ended at that point on that cycle, and it traded strongly upwards as part of the continuing trend that had already been in place in the first cycle. In the second cycle, we see again 1, 2, 3 month decline, correction against the major trend, and then a strong resumption of the trend. Okay, not particularly convincing examples, you might think. However, look at the next one. This was the cycle of 2002, and as you can see, it ends a 2-year decline and commences the 5-year bull market that we've seen up to October of last year. But just in case you think it missed, so to speak, let me show you something. Let's turn this back into a candlestick chart, and what you're going to see is that in fact this was the low month, because it spiked lower than the previous bar. So in fact that cycle did catch the exact low of the decline and then start the current uptrend. So the point is, this is reinforcing the whole story that we've seen so far. It created this low 5 years ago, effectively as a time cycle to that low, and then the next 5 years out, October, we see the top coming in with the price projection that we talked about earlier off of this low. So that's probably the end of this video. We'll continue on video number 2.